Welcome to Markets Now. I'm Michelle Rook along with Alan Brugler of Brugler Marketing, and we did end mixed in the livestock futures on Monday. Grain setting back here. And Alan, how much of that, like corn and soybeans, was tied to just removing some South American weather premium?
I think on a Monday morning that was a given. You had some rains over the weekend. The forecast for Argentina looks a little wetter over the next week. Southern Brazil actually looks a little drier, but it was a good excuse to take some of that meal premium out, and of course that flowed over into the soybeans as well.
Yeah, and you do have fund liquidation going on, and how much of that is a result of, I mean, it's easier to move a market during the holiday because of, the light volume, but it is into the year too, isn't it?
It is the end of the year, and we have to remember that for the year we're up, right? Most of these commodities are still up on the year, so you're going to see some. If you're taking profits, you're going to see longs liquidating more so than you are shorts covering here.
And Neil actually took it the worst out of the soybean complex, didn't it?
Yeah, we actually had the bean oil was up a little bit today. The meal took the double-digit loss and accounted for most of the loss of product value there. And again, the beans may be losing a little inflation premium, and some of those index fund traders as well coming into year end, taking some of their inflation bets off. But loss of the product value is the big driver here.
Okay. So you're saying we still have some hangover left over from the Fed announcement and kind of what's going to happen now here in the new year, because there's a lot of recessionary fears still circulating or starting to circulate, right?
There's a lot of recession fears, but it's also taking money out, going to cash or over the holidays, just kind of parking it and waiting to see what to do. One thing that's different than a year ago is you actually can get some yield on money that's parked on the sideline. A year ago, you were looking at very low interest rates and you really had to put that money back to work. Now you can kind of say, well, I can at least get some interest on it while I'm waiting. Let me take a week or two off for Christmas and then we'll come back.
So funds have liquidated a lot in the corn market already. Do you anticipate that there is more liquidation ahead or not?
I think they need a story. They need a bull story. If it's not going to be inflation, it's got to be some kind of tight stocks or certainly we are starting to see a little bit of a pickup in corn export sales. We need to see more of that going forward. The other issue is simply farmer selling on corn has been very light here. You're seeing the commercials liquidate a lot of their short positions because they don't have the grain in the house, and the funds can't buy if there's no short paper. So even if they wanted to get in right now, it'd be a little difficult.
Will that farmer selling maybe happen after the first of the year? Because some of that's probably some income averaging and whatnot, isn't it?
There's a lot of producers that don't want the money till after the first of the year. That doesn't mean you won't sell the last week of December and ask for a check after January 1. But what we've been seeing is more soybean cash sales and kind of setting on the corn.
All right. The other problem with corn has been the wheat market, and the wheat market continues to fall here. The funds are already short. How much farther down do you think we're going to go in that market?
Well, you can have a long-term or a short-term perspective. Short-term perspective, we're oversold. We're very near the previous lows. We're at a great place where we could stop. Now, long-term perspective, we had a 9-year cycle low in 2016. We had the 9-year cycle high with the Russian invasion. So we would expect wheat would grind down into 2025 if we're looking strictly long-term. Now, that doesn't mean we have to go there in one fell swoop. We can bottom here. What we need is some export sales. USDA is already projecting the worst export sales for wheat in decades, but we're not making that number yet. So we need to have a holiday sale or a post-holiday clearance sale here and get some business on the books.
And I know it might be the wrong time of year for it, but we do have cold temperatures moving in, and we're not seeing really much weather premium in the wheat market either.
That's true. We're not really betting on any winter kill here. It's easier to bet that in February than it is in December. A lot of the crop is dormant. If we get a little snow cover, then the cold temps aren't going to be an issue. Having said that, we are looking at record cold temps here, and any ground that's exposed could be vulnerable. It's just we won't know till spring how much damage was done.
So did we do any technical damage in any of the grains today?
Well, we had some very, very short-term signals, uptrend lines of that type a thing that were broken today, but we held at the 18-day average in the beans, and some of the other retracements held. So yeah, it looked uglier than it probably was in terms of technical damage.
Let's move over to cattle. Nearby contracts a little bit higher today. And, does that market have any weather premium in, or are we trying to build just a little bit of weather premium there?
I don't see a lot of weather premium there. I see the board being discounted to last week's cash. I saw the cash up a little bit, maybe wanting to get some cattle to move there. Obviously, cattle movement is a problem when you get sub-zero temperatures and these -20 wind chills that they're calling for later in the week. So that's going to interfere with the movement to the packers a little bit. But no, I'm not seeing a lot of weather premium in here on the cattle market. Yeah, I think the key point there is over time cattle are going to go higher. Cattle cycle says that, but they don't have to go straight up.
Right, and that's why we have the premium in the back months, right?
Yes.
So do you anticipate that at some point the front end is going to lead, and when is that going to start happening?
Well, we're battling some lateral resistance, old highs right now. In the next dollar or two, the feeder cattle have broken through their speed line resistance, which suggests they'll go up over time, and should, because that's where the shortage is going to happen first. You start losing the heifers that are in the feedlot now. They start keeping them back for cows, then feeders will get really tight. But again, the issue there is you almost need to see the grass development, and you need the pasture development before the cow-calf guys are really going to press for heifers.
Okay. We saw two-sided trade in the hog today. I'm not sure exactly what is going to be the main driver of that market going forward, except for, if we can bottom this cash and cutout market, certainly that would help, wouldn't it?
Yeah, and we should be getting close seasonally. You have that tendency to drift lower into the end of the year, then to pick up a little bit Jan, Feb, March on the cutout side of things, on the index side of things. So, most of the slide should be over with that you anticipate in the fall into December. But having said that, the hog numbers are tight, and we do have the hogs and pigs report on Friday. I'll remind everybody of that, the quarterly report, and that'll tell us whether we're still downsizing or if we're kind of maybe trying to keep a few gilts back here and there.
All right, that'll be important to watch. Thanks for joining us, Alan Brugler with Markets Now.